All right. Good morning. It is Monday, July the 17th, 2023. We hope you had a nice weekend. It was a warm one here in Charleston. Saturday morning, I mowed the yard, played a little bit of wiffle ball with the kids, and that was about the extent of me being outside this weekend. It was warm. So a lot of reading. Played some Legos inside with the kids. So that was good. I'm getting a haircut this afternoon. Where is it? Yeah, I still get these hockey mullets from time to time, and I don't really mind it in the winter, but in the summer months, it gets this hair is just a little bit too much for this time of year. So kind of excited for that afternoon haircut. All right. Last week in the market, a good week for both stocks and bonds. And it all starts with inflation, okay? And at this point, we've kind of been going over some of these concepts for a while. My hope is for some of you, you can kind of start to see the way this domino effect can work for the better or for the worse, depending on which inflation is headed, right? So last week we get the June numbers for CPI, Consumer Price Index, which came in at 3% year over year, as well as PPI, the Producer Price Index, which came in at just 2.4% year over year. Okay, so better than expected, lower than expected inflation numbers. Okay, so how does this work in markets? Okay, so lower inflation. First thing to think of is, okay, that means even if the Fed is going to hike, maybe one more time later this month. The long-term expectations would be that they're probably really close to done. Okay, so on that news, remember markets are forward-looking, so you see yields really come down hard. All right, so the 2-year Treasury started last week north of 5%. That came down at one point to about 4.6. That's a big move in yields. The 10-year Treasury goes from 4.1 at the beginning of last week down to 3.7 at one point. So really like a 40 basis point move, both of the 2-year and the 10-year. Okay, and then remember, lower yields means bond prices higher, right? Because there's an inverse relationship. So yields down, you get bond prices higher. All right, take the domino effect a step further. Okay, knowing that inflation is going to be was priced lower, you have yields lower, the expectation that rates will be lower in the future means the cost of borrowing, right? The cost of investment for companies in the economy and for the consumer, right? Mortgages, car loans, HELOCs, things like that. More affordable borrowing. All right, so on that news, of course, you have the equity, the stock market go up as well. So pretty much across the board, really nice week last week for stocks and bonds. This week could be interesting. We're starting to get more and more. We'll get more earnings reports. Okay, so we'll see both like the strength of the consumer as well as potential margin compression from companies, right? Because with the inflation we've had in the recent year or two, obviously a lot of those input costs that companies are dealing with. So we'll see the way that passes through for profits. So questions, comments, concerns, we always love hearing from you, and we hope you have a great week. Thanks.